Hey guys, Dave Hathaway Property Management. It is deal day. On deal day, each week we look at a new property in a new market. This stresses repetition, discovering new markets, and becoming a better investor. This week somebody asked me to analyze West Philadelphia. So I randomly went in there, looked around at a few properties. I have visited Philadelphia, but by no means am I an expert on the market. But we ended up choosing a property which is 153 North Peach Street in Philadelphia, PA, 19139. Before we look at the property, it's always a good idea to look at the market itself. If you get a mediocre property in a great market, it will increase your values, rents will increase, and vice versa. If you get a mediocre property in a terrible market that maybe only has one job employer and that job employer leaves, then your rents will go down, or you won't be able to rent out your property, and the price that you can sell that property will go way down. So it's important to look at the market first. Looking at the market, if we look at population growth in Philadelphia City, it's declined year over year, 22,000. That's not humongous, but something just to note. For unemployment, it's actually gone down and it's now 4.1%, which is a good thing. And then job growth, it's 52,200 or 5.2% of job growth. So the job growth and unemployment are complementary numbers and they're supporting each other. The next thing we like to do is we like to go over to Google Street View and just see how it looks from the street. If you're finding lots of people hanging out on the sidewalk or lots of people sitting on the porch, or there's just lots of people in general, transients on the block, it's probably not a property you're going to want to deal with. It's going to have more headache than not. This one actually, you can go through the years on Google Maps. If we'll show, it looks like it starts in July 2007, October 2009, June 2012. And I'm just going through the years and just looking down the block. And I'm actually pointing at the alleyway because a lot of times crime happens or hanging out happens on the corners. So it doesn't look like we have that for this property. So we'll give this one the clear to go with the Google Street Maps test, and then we'll move on to the next test. Next, when you're looking at the actual listing photos of the property, it looks like somebody rehabbed this one recently, and either they had a tenant move out or they just fixed it up to sell it. They have it listed for $166,000, and it's a 4-bedroom, 2-bath. Having that extra bedroom's always nice because you can get more rents. In general, usually your ARVs are higher, but the things that stick out to me right away when I'm looking at this property are I see that the siding on the front of the property is vinyl, and I also see that there's no carpet. So these are going to be low maintenance things that are good that you should look for. It also has stainless steel appliances. It looks like you're not really going to have to do any rehab. That being said, we always like to put in some sort of contingency because usually when you don't think you're going to have a rehab, that's when you have a rehab. So we usually like to put in like a $5,000 or a $10,000 contingency, even if you don't think you're going to have any. Looking around the sale comps, it looks like they're listed appropriately. You could probably offer a little bit less. Let's see how many days the property's been on the market. So it looks like they just adjusted the price down from $169,000 to $166,000 back on June 5th. So I'd say that you could even put in a lower offer. It looks like Zillow has comparable sales at $153,900. I'd say the property is worth a little bit more than that, but it looks like it has Zillow rents in about $1,560, which I'd say is appropriate. The taxes for the property are $950, and the insurance for the property is, from my experience, somewhere around like $70 a month. And if you guys don't have somebody that is getting you somewhere around that like $800 a year mark for a townhouse, and you're investing in Philadelphia or Baltimore or Virginia, reach out to us via email and we will connect you with the insurance broker that we work with. But you go and you start looking at these numbers, and looking at the numbers, they look pretty good for a rental. The things that stick out to me are ROI without a loan's 9%, which is not terrible at all. With a loan, it's 12.8%, which is almost 13% with a loan, and that's awesome. But then also you can see over on the right-hand side that if the property appreciates at all, it starts pushing those ROIs up. So at a 1% appreciation rates just in a year, it's going to push that return up to 16%, which is nice, almost 17%. And the last thing to note is that the property cash flows pretty well, $450 a month, and that is with a management fee of 8%. and a vacancy rate of minus 10%. So you have those things built in there. Overall, I give Philadelphia a thumbs up. I think this is a great, numbers for a great property. It's not a home run by any means, but it's definitely a great long-term real estate. Should be thought of as a long-term vehicle and not a short-term vehicle. Last thing to note is this almost meets the 1% rule. What that means is that of the sales price, the rent is about 1%. And if you did get it for 153 or 154, it'd actually be over the 1% rule. So, and that's always a good metric to look at. That's it. Philadelphia, PA gives a thumbs up for me. If you guys like this video, please subscribe. Let me know what other markets that you are interested in that you want me to analyze, and we will do it for you. Thanks, guys. See you on the next one.